For most of us, taxes are a constant presence throughout our financial lives. Every paycheck you earn for decades is subject to income tax, and should you manage to build a significant nest egg, the government extracts a final portion through estate or inheritance taxes after you pass away. This chart, built from leaked IRS records, shows the mathematical gap between that experience and the reality of the ultra-wealthy. A typical household earning $70,000 pays about 14% in federal taxes. But when you look at the world's top billionaires, that rate drops to a fraction of a percent. This is a direct comparison of wealth growth versus taxes paid. Between 2014 and 2018, Warren Buffett saw his fortune grow by $24.3 billion. During those same 5 years, his total tax bill was $23.7 million. That is a true tax rate of 0.1%. Despite publicly advocating for higher taxes on the wealthy, Buffett is one of several billionaires whose tax bills represent only a tiny sliver of their actual wealth accumulation. This suggests that the ultra-wealthy are not just more successful at the same game. They are operating under a different set of mathematical rules that allow billions of dollars to remain legally immune to the IRS. To see how they do it, we have to look at how the IRS defines a capital gain. When you buy an asset, your original cost is your basis. If you buy a stock for $10 and sell it for $1,000, the IRS only taxes that $990 difference. This is why many founders, like Jeff Bezos, take microscopic annual salaries, often just $1. In the American system, standard wage income is the most heavily taxed form of money, often reaching rates of 37%. Most of their wealth is held in company stock. As that stock appreciates, they sit on what are called unrealized gains. Because of a legal precedent dating back to 1920, the government cannot tax those gains as income until the owner actually sells the shares. Instead of selling and triggering a tax bill, the ultra-wealthy use their unsold stock as collateral for massive, low-interest bank loans. This allows them to access millions in cash without ever generating a single dollar of taxable income. By spending borrowed money rather than earned wages, they can fund their lifestyles while legally reporting little to nothing on their tax returns. This strategy leads to an inevitable problem. Eventually, a billionaire will die while still holding billions in unrealized gains and outstanding loans. Normally, that would trigger a massive tax bill for the heirs. The step up in basis resets a stock's purchase price to its market value at death. For heirs, decades of financial gains simply cease to exist. Inheriting stock with a $180 basis and selling immediately means their taxable profit is zero. This functions as a respawn button for money, sanitizing a lifetime of wealth growth of all historical tax liability before passing to the next generation. The scope of this is massive. ProPublica found that the top 25 billionaires accumulated $401 billion in wealth in just 4 years, most of it untouched by the IRS, waiting for death to make it permanently tax-free. The step-up in basis allows these fortunes to teleport across generations, growing indefinitely without ever being subject to the capital gains tax that applies to everyone else. While regular workers fund the nation's infrastructure and social services through mandatory payroll deductions they cannot defer, the ultra-wealthy can choose when or if they ever pay. This reflects a century of legal evolution. Since the Supreme Court ruled in 1920 that income only exists when gains are realized through a sale, the code has been built around the principle that holding assets is not a taxable event. The step-up in basis is one of several mechanisms used to avoid taxation. There are other, more complex legal structures that allow billionaires to benefit from assets that are technically no longer in their possession. One such structure is the Charitable Remainder Trust. It allows a billionaire to donate assets to a charity they control, take a tax deduction for the gift, and still receive a steady income from those donated assets for the rest of their lives. We're breaking down exactly how those trusts work in our next HEO. Subscribe to make sure you see it, and if these numbers show you a side of the system you didn't know existed, share this with someone else.